Our second panel is going to be blockchain as a business application. And we've got Jamil Jaffer, I'm delighted that he's our moderator. I'm going to give you a very quick background on Jamil. Jamil is the founder of the National Security Institute, and they're our sponsor today, so thank you again for that. Jamil is also an adjunct professor here, and he's involved with lots at the school, but very close into counterterrorism, security, cybersecurity, lots of things that we're talking about on the national security matters. Recently, too, he was he clerked for Justice Gorsuch. He worked in the White House in a prior life, and he's just really an all-round fascinating individual, and really delighted to have you here today. So I'm going to kick it off to him, and he's going to moderate our panel this afternoon.
Great. Well, thank you for that, Philip. Appreciate it. And I think this microphone's working. Can you all hear me in the back? We'll just talk loud and make this thing work. Well, thank you all for being here, and thank you to YPO for co-sponsoring this event. I want to introduce our panel, and the way we're going to do this is I'm going to introduce the panel. We're going to have each one of them give 2 to 3 minutes of their thoughts on blockchain as a business application, and I'm going to try and throw out some questions, get a conversation started, spice it up a little bit, and then open it up to you guys for questions from the audience. So, Ethan Gilmore is the founder and CEO of VarCrypt, a blockchain-based company that looks at bringing security to all sorts of media applications, from VR to video to you name it in the digital realm. Prior to founding and starting up VarCrypt, Ethan was the president of Virtualize, a virtual reality-focused technology and media company. He's worked in media entertainment and the alternative investment space for years, as well as, interestingly, at the UN High Commissioner for Refugees. Next on the panel is John Dwyer. John's a senior analyst with Celent's Securities Investment Practices, is based out of London, so thank you for coming all this way, John. He focuses on capital markets fintech, including blockchain, digital assets, cryptocurrencies, utility tokens, ICOs, and the entire evolution of the buy and sell side business models. John is a thought leader across these areas, and previously served as head of emerging markets ECM at Macquarie Capital, natural resources ECM at Macquarie Capital, and Middle East ECM at Goldman Sachs. Pat Wilkinson, third on our panel, is a general partner at Exponential VC, a venture capital firm focused on empowering entrepreneurs. He's got a deep technical background, but most importantly, he was a Black Hawk helicopter pilot after graduating from West Point Military Academy, and I believe was a tight end on the West Point football team, if I'm not mistaken. Yeah. He's been involved and led the creation of several multi-billion-dollar companies or divisions of Fortune 100 companies, and is an expert in hyperscale data storage and computer architecture, and has created the computer infrastructure for companies from Google, Facebook, Amazon, and was a growth guy for Western Digital most recently, running multi-billion-dollar P&Ls. And finally, last but certainly not least, Thomas Jarzewski. Thomas is the head of architecture and digital design and is a distinguished engineer with S&P Global Market Intelligence. He drives growth by improving and innovating business and IT functions, by delivering academic knowledge, practical expertise, and customer-focused leadership. Thomas has held a variety of leadership roles in the tech industry, including head of delivery, head of architecture, and CIO. He serves on a variety of academic advisory boards, and so we've got a very distinguished panel. So let me start out with you, Ethan. Tell us what you think of when somebody says to you, does blockchain have serious business implications? What can it do for business? 2 to 3 minutes on that.
Sure. Well, when I've been in the blockchain space now since about 2015. I also worked briefly in hedge funds and investment banking, and I would say the number one use case I think for blockchains and how blockchains can be used for almost any business basically is decentralized data storage and data encryption. And whether that is a Filecoin type structure or IPFS, if some of you are familiar with that, I also think just the broad applications of encryption in the future. We all know that we could all use more encryption, we could all use more data storage. The other thing, and this can range from encrypted email servers to also capturing your own corporate data and turning your corporation into your own data refinery, and then basically keeping track of your own data, compartmentalizing it, rendering it, and then figuring out what part of it you would like to sell and to whom and for what price. So these are the applications there. The other great use case, I think, for blockchains, and we keep hearing about Internet of Things. People have been talking about it for years. Others are going, well, where is IoT? When is it going to get here? You can utilize blockchains as a delivery device for IoT. And there's also big data components. If you're interested in machine learning, artificial intelligence, all of those things can be plugged into a blockchain ecosystem. So really blockchains are more of a foundation for a technological ecosystem, but the applications are I don't want to say unlimited, but they are very, very diverse. And those are the things that I think of.
So John, Ethan laid out the concept that blockchain is a fundamental foundational construct for security and for enabling a variety of traditional activities as well as sort of newer things like the Internet of Things. How do you think about blockchain in its practical business applications?
Okay, so I got to this in sort of 2012, 2013, and what I do now is I provide strategic advice to financial institutions about the impact of both private blockchains and public blockchains. Private blockchains being those which initially were consortia owned by financial institutions, by the likes of R3 and Digital Asset Holdings, and are about cost savings within existing value chains in the capital markets and banking and elsewhere. That's reasonably interesting. What's happening in the public blockchain sphere, which is what we're here to discuss, is extraordinary, given the open source protocol nature of what they do. Bitcoin is the first proof of concept of peer-to-peer movement of value with cryptographically secured digital scarcity. Those last two words are the most important, digital scarcity. What Bitcoin does, and I'm going to use the term token. Tokens facilitate an entirely new means of commerce by bringing together four things. That's utility, financial incentives, network effects, and game theory. So if we go through each of those, in the case of Bitcoin, I'd use that as an example. The utility is its digital scarcity. In terms of financial incentive, for me as an individual, I'm buying it for its store of value properties. It's speculative value right now. As a miner who validates the network, you are engaging in that process so that you can earn the block reward, earn Bitcoin, or earn fees. So the financial incentives, it's about executing financial self-interest driven by utility. On top of that, these are open source protocols. So the crowd watches the crowd, which means that if one of the miners tries to behave fraudulently and mine a block to try and achieve its own version of the Bitcoin blockchain, the crowd can see them. That stops them doing it because in order to mine that false block, it costs them money. And that imposes a discipline on them from a game theoretical perspective because they are then forsaking the transaction fees or the block reward of behaving honestly. Therefore, from a game theory perspective and network effects, you have this imposed discipline on all of these unconnected parties who are driven by financial self-interest and utility. It's almost easier to describe what tokens aren't than what they are. What you don't have is a traditional corporation or enterprise. You don't have a traditional shareholder. You don't have equity or debt securities. So it transcends traditional securities analysis. You don't have a licensing agreement or a traditional relationship between an enterprise and a supplier or an enterprise and a customer. What you do have is open source protocols with incentivization attached, which is a radical change, because that is going to fundamentally change the internet, the middleware of the internet. What the token is, it's a store of value of the utility generated by that particular protocol, and it's a medium of exchange of that utility. Ultimately then, to summarize this, what we have is the first peer-to-peer movement of value and digital scarcity, which is a breakthrough in computer science. Through tokenization and ICOs, we have an entirely new means of capital formation, which is going to impact business strategy, which we'll come and talk about. And in terms of the token, which captures those four elements that I talked about, we actually have a new form of capitalism that leverages network effects and game theory. You put all of that together, that is going to make us challenge how we think about some very, very interesting concepts, including corporate finance, corporate valuation, corporate governance, and capital allocation, and it's going to radically change the structure of the global economy.
So Pat, I mean, we've now heard sort of that blockchain is a foundational technology for traditional business applications and really securing things. And John tells us that it's going to fundamentally change how we create capital and how capitalism itself, structured capitalism works. These are pretty heady stuff. How do you think about this problem from the investment perspective? How do you see the practical business applications of blockchain?
Really good question. So we're believers, by the way, so we'd like to kind of echo and support the themes you've already heard. and maybe a bit more on our perspective, just to kind of help kind of put context on kind of our philosophies. We're early stage investors, so invest in startup companies and entities with a keen focus on, call it enterprise compute infrastructure. So the enabling compute that helps us as a society run our businesses, communicate, digest content, whatever the case may be. That technology foundation is what we focus on, like to invest in. Some people might say, oh, here's a venture guy. He's probably going to talk a lot about ICOs. We look at a considerable number of ICOs. We have not invested in one yet.
Not one.
Not one yet, and not to I'm trying to say that they're not a good thing. I'm just kind of trying to say we're not here to sensationalize ICOs and things of that nature. But what we do see is fundamental value being created around the next instantiation of globally scalable enterprise infrastructure. So the foundation upon which our businesses are run, we largely believe will be enabled, impacted, and will flourish because of the blockchain. Maybe a bit more on that, just to kind of finalize the thinking and the logic there. We've been really focused on cloud enablement and cloud infrastructure as an investment thesis and work experience and the like. And we found that we've got to a point where while the enterprise is embracing the cloud, there are still impediments to adoption. And there are matters of immutability, traceability, auditability. And, they say some of these things, you start thinking about, oh my gosh, blockchain could be a great, potential enabler or solution for that. And then we think about IoT, and the fact that it's massively distributed, and there's nodes and sensors everywhere, so there's a scalability challenge. So these are big fundamental challenges that these massive monolithic clouds, upon which we built kind of the first generation of cloud computing on Amazon Web Services, Google Cloud Engine, clouds that were designed for, in one case, e-commerce, and then fortuitously kind of moving into enterprise computing, Google doing it for search and saying, hey, I can let enterprise run on it too. If you were to deliberately design a cloud today, you'd say, wow, enterprise computing and IoT would be where I want to go. And then if I were to design it from the ground up, what type of capabilities would I be looking for? And so you definitely want to be leveraging state-of-the-art tools of computer science. So you want something that's distributed, you want it to be massively scalable, you want it to be open source, you like it to leverage peer-to-peer. So these are all great core principles that are part of the blockchain and independent of the whole cryptocurrency aspect of it. And so our focus is really on that I don't know, called fundamental value that a blockchain represents and how it can be applied to the way in which we want to, architect, if you will, the future of enterprise computing, enterprise cloud.
So Thomas, Pat just laid out this construct that essentially blockchain will be the foundation for Cloud 2.0. That's a fair sort of summary of it. You and I talked yesterday a little bit about AI and the way that AI is going to affect our global economy and the way we think about computing and technology and the way the next generation of young technologists and young people generally interact with the world. And you made the case that blockchain in some ways is fundamental to adoption of AI. Talk to us about that a little bit.
Absolutely, yes. Thank you very much. So I'm also a believer, like everyone is here in this panel. I'm a true believer in the blockchain, and not just because I like this technology. I've been working in this technology since late 90s. I've been working in IBM and cryptography. Back then, I remember when Gartner says that the adoption of the cryptography will take about 10, 15 years. And then I was working on a consensus algorithm and a protocol of the X open for the distributed transactions that are implemented in all distributed databases. So I know how hard it was to implement, and I know how many times we failed and how many PhD on the staff we had and how hard we worked, and all of a sudden I can see all these technologies working together with the peer-to-peer computing and bringing that infrastructure. So if you take that infrastructure and think about how we do in our lives, everything what we do is really the process, is the steps of the tasks. And between this step of the task, we do the human interaction, right? So if you take that and move into the blockchain, there's no really human interaction between the tasks, the steps, okay? There's basically just a smooth flow from the very beginning to the very end. That's what they call the smart contract. That's the application. So the blockchain really simplify the complex workflows that we execute whether in our lives, whether in our works, but that's what's going to happen. So now, when you take that, okay, and think about what that really is, what that really sounds like, that sounds like autonomous machines, okay? So that means that once you start training this model, they will be executed in a blockchain to the very end, okay? Now, you know what the cybersecurity is today, right? So the cybersecurity, for the most part, is disrupting you to stealing the information. But to think about the other side of it, the reverse actually side of it, okay? So now, when we are training the model, because in AI, you really have to train the model, right? So the model know how to react to a particular input to give you the proper feedback. What if the cybersecurity start putting this data that is not valid data, it's a fake data, okay? Then first of all, you do not know whether the trained model is trained correctly. Secondly, even if it was trained correctly, how do you know whether that particular data that is inputted, right, which is basically taken to the artificial intelligence, the machines, or basically truth data, so you're going to have the expected response. We just don't know. So that's why the blockchain could be the infrastructure, okay, future infrastructure for running the artificial intelligence and be immune to cyber attacks, be immune to the fake data, based on the nature of the protocols, okay, that validates the data and informs about the truth, the only one truth, and also embedding the data by the Oracle services, Oracle, which is the trusted data from the trusted parties.
So thanks for that, Thomas. So before we get into practical business applications, I want to ask sort of a more fundamental question about blockchain. And since we've got 4 believers on the panel, I'm going to play the skeptic. And tell me, why isn't this digital scarcity problem going to fall apart, John, when miners no longer have the incentive of being able to mine Bitcoin? All they get is a transaction fee. When the value of mining goes down, and as the cost is accelerated, why does anybody validate transactions anymore?
Yeah, so there's only 2 ways that you can incentivize the miners to perform that function. One is through inflation of the currency, which is your point. At some point, though, given the predetermined nature of the currency issuance, it levels off, and then it's only through transaction fees. So you're absolutely right. It's going to be interesting to see when it's purely transaction fee driven, is a transaction fee going to be sufficient to actually incentivize the level of work that's required in order to execute the transactions. Now, to the point that was made earlier, I think in the lunch, which is that, you know, I'm a big believer in Ethereum, but I think it could be usurped by EOS and others. You know, as we all know, whenever it comes to a new technology, the first movers may not necessarily be the ones there at the end. There are many other implementations of the Bitcoin, either structure or indeed its original code base, which have created new and improved versions. Dash, for example, they've got much better innovation and governance structures, and there's different consensus algorithms which have got a completely different economic structure. So I think with time, the short answer is we'll see. It's a function of economics and computer science and good old capitalism.
So another question on since you raised the question of consensus, and I'd love to get Ethan and Thomas your points of view on this. So right now today, it's all about getting consensus on an agreement that the work has been done, the work's been successful, and it's accurate, and then you can be added to the blockchain. What happens when consensus is lost, or consensus fails, or there is a 51% takeover of a given? Does that blockchain simply collapse and we just shift to another one? Or is it a fundamental problem with the blockchain that might undermine the entire construct?
Well, I think structurally, the blockchain space is filled with some interesting paradoxes right now. One is it's decentralized. The other is it's supposedly unhackable, right? If you have to hack the firewalls, everybody that's mining, but you have to keep going through these hackable and centralized areas, whether it's you're going through a centralized exchange or you're also going through a wallet. Wallets are the scariest. They're the thing that scares me the most about this space is just how literally janky a lot of these wallets are. They get
a technical term.
Yeah, that's a very technical term, and they can get hacked pretty easily. Some of these exchanges, we also know that all exchanges are not created equal. We have some of the best exchanges in the world here today, but some of these other ones that are less unscrupulous and offshore,
China.
they get these hacks, and I wonder half the time if the hacks are internal, you know. But we,
Maybe people just extracting value as
yeah,
part of the business
I mean,
model.
I don't know if some of these guys are setting up a Raspberry Pi and hacking themselves and just saying, oops, we got hacked and we lost, 500 million coins. And
Which
they're,
happened to be in their back pocket.
right, right. So, but in regards to 51% attacks and things like that, I would say that would be either a mining cartel, because most of Bitcoin is being mined by specific cartels out of Russia and China. If they can get 51% control, which can happen, that can be a problem. You really need to have node diversification in a blockchain. So if it has those structural... Node diversification, mining diversification. And I'm really excited about certain projects, in particular Space Chain, which is being started, which is Jeff Garzik, who is the second programmer on Bitcoin. They're setting up nodes in space to mine blockchains. And I heard them actually talking about they're launching swarms of 10 by 10 satellites to actually have complete diversification in space with no central point of failure to mine various blockchains. So all of these are new
Except
tech.
they control it.
Well, it does depend, right?
Okay.
It does depend. So I would say if you have mining concentration in excess of 51%, that is your own fault for not getting enough mining diversification. And in that case, it could collapse. But I think as the currency rises in value, you'll get more and more people mining, which will add to diversification.
So Thomas, you're the engineer on the panel.
So yes, I'd like to just take a shot to demystify it.
Yeah, please, that'd be great.
Demystify the hacking algorithm, etc., about the 50%. We have to understand that there are two notions of the blockchains, right? And there's a private blockchains and there's a public blockchains. And the private blockchains, for most part, is a DLTs. They are not really the blockchain, which I don't want to get into the details because I'm going to lose you, 90% of you, okay? But the truth is, okay, that two blockchains that we're talking about is today, it's a Bitcoin blockchain, Ethereum. There are public blockchains. They do have notion of validation and rewarding these miners, okay? And you have to have at least 51%, okay, majority of the votes actually to validate the transaction and making sure that that transaction, right, is valid. Now, if anyone knows what the birthday problem is, I encourage you actually to do the Wikipedia and just to do the, check it out, the birthday, okay? Basically, it's not just the 51%. I mean, it could be actually happening in the 25% and the 30%, okay? That the ability actually to...
You're not making us feel better about security.
Well, there's a few aspects of security as well to this, right? But what I'm trying to say is that we only talking about the public blockchains, okay, when we're talking about the money. But the private blockchains, they do not have these problems, okay? The node validation is a collapse from millions of computers to maybe 5, 7 computers. Usually it's the Fibonacci number, okay, which is basically a single number of it, okay? So we know who actually is validating the transactions. And matter of fact, majority of enterprise applications are not going to be in a public blockchains, are not going to be in Ethereum, okay? And it's not going to be certainly in a public blockchain, Bitcoin blockchain, okay? Those will be either on a Hyperledger, and a Quorum, R3. I'm not calling R3 blockchain because they're saying they are not blockchain, okay? But those type of blockchains, those type of DLTs are quite different. That they behave quite differently, and they expect to solve also different problems, okay?
But that's not this vision of the distributed blockchain then, right? This is the sort of centralized internal private blockchains that John was talking about, right?
No, I would not agree with that statement. That's not really centralized, okay? Private blockchain doesn't really mean that you have a single authority, okay, to manage the blockchain, okay? Private blockchain means that you know the participants of the blockchain, okay? So you basically admit them to the network. Matter of fact, okay, there's, and we wrote the white paper about this as well, and matter of fact, I also did a reference architecture in our S&P Global company, how we basically adopt the private blockchain to be the public blockchain. So in other words, we like the idea of the private blockchain because we preserve the privacy when we need to based on a single smart contract, based on application. But we would like to have the people to actually contribute their data so we can make the self-signed participation, meaning that if you're the IoT device and you like to contribute the data and read the data, you can self-sign for it, okay? You just basically log into the Wi-Fi to this blockchain network and say, hey, I'm the XYZ and I'm going to contribute to it, and nobody will stop you to do it. So the difference between the public and the private is basically the level of the privacy of data that you contribute, of the transactions, okay, and your agreement between the transacted parties.
So Pat, you talked about the idea that blockchain can enable essentially cloud 2.0 and really get rid of some of the friction that's caused in cloud adoption today. Do you then think about blockchain principally as a underlying technology that will sort of work behind the scenes and make things faster and better, sort of the BASF of modern technology and cloud computing? And if you do believe that, then are there consumer-facing applications where consumers actually directly interact with the blockchain and they know it and they have to think about it and work through it? Or is it purely a structural thing like TCP/IP behind closed doors? You know it's there, but you don't care. It just works.
It's great question. I believe it can be both in the sense that, firstly, we view blockchain as kind of like an infrastructure enabler, like a TCP/IP layer, type solution that ultimately has the opportunity to span the entirety of kind of the operational flow of a business, such that it could reach out to if an entity has a consumer application, if it's financial services, or if you're a Walmart, or whatever the case may be, you have the opportunity to actually extend all the way out to the consumer and the final node in kind of your network, whether it may be. Autonomous vehicles is a great example of that. Toyota's been quite vocal about kind of the impending challenges they face with the deluge of data as millions of vehicles are moving around, generating more data per vehicle than a typical enterprise generates at the same pace. So we've got that type of issue in front of us. So the applications thus can expand all the way out to kind of that which we kind of can tangibly interface with as consumers and users.
So Ethan, you're building a consumer-facing blockchain-enabled application. Is that true?
Yes.
Tell us about that piece of what you do, and why you think that's a game-changing sort of consumer/business application. What makes it game-changing? And then John, I'm interested to hear what you think is sort of in the near term, in the next 1 to 2 years. What is the killer blockchain-enabled app? Ethan, I'll get you first.
Okay, so we've already built our own blockchain. It's functioning. It's being mined. The blockchain is called VarCrypt. We're also our own cryptocurrency. It's called VarCoin. We're a Bitcoin clone. The whole mission of VarCrypt and VarCoin is to create a content distribution system that will basically globally distribute, encrypt, and monetize different types of content, whether that's VR, AR, or legacy content. So film, television, music, software.
All the stuff we grew up on is legacy content.
Yeah, basically anything that's not VR or AR now is called legacy content.
Forget radio. Forget
so,
vinyl.
Yeah, movies, even Netflix, et cetera, et cetera. And I've monetized a lot of content back in my hedge fund investment banking days. We did a couple $100 million of it. We did a lot of it also in Germany. And I think that blockchain is the perfect way to distribute, encrypt, and monetize content, and also transparently pay content owners very clearly. If any of you are familiar with studio accounting, all you have to do if you're in the movie business is look up studio accounting, and you can hear about the horrible ways that the Hollywood pays actors, directors, etc. There's all types of. It's just not transparent. And even iTunes and Netflix and Spotify, they're really not paying artists transparently at all. And the whole point of blockchain would be to fight piracy and to basically make it very, very clear what everybody's being paid. And The second you come to us, we will distribute you globally as well. So no longer selling off content piecemeal by territory. So that's why I think we think that's revolutionary, and it also doesn't exist anywhere yet. There is no marketplace that we're seeing VR, AR, film, television, music all put together globally, and you're also getting the cost benefits of transacting and enabling micro payments and microtransactions. I think the minimum cost that you can put through a credit card now is 20 or 30 cents. So let's say you want to just pay 4 cents to read an article on the New York Times. And the other thing is you can track all of this stuff.
You can't do it because of the fees.
Correct. So that's one application. It's something I've been working on since late 2015. I'm involved in other projects as well, but that's really, I think it's a good use case. I believe we're the first ones to actually ever publish any VR content on a blockchain. Ours wasn't actually operating at the time, so we did it in partnership with Alexandria. It's time-stamped. We used a VR player that we got off of GitHub, so it actually doesn't work anymore, but it's time-stamped on a blockchain. And we're pretty excited about this.
So John, global advanced content distribution, enabled, secure, able to buy it in small chunks, really efficiently, dramatically increasing the efficiency of content distribution and allocation of resources to the actual creators of content. What do you see as that killer blockchain app here, literally the next year or two? What's that amazing thing that we're going to do on the blockchain that we're not even thinking about right now?
So I think the key areas for me this year is digital identity. And I think this is where you're going to see alliance between traditional industry and financial institutions and public blockchains. I'm sure everybody in this room has got experience of going through a KYC or an AML process with a bank or a broker or a utility, whoever it may be. And you go through that process, and then when you go to bank number 2, you have to go through that process again. And increasingly in Europe, for reasons of regulation, you have to renew that process on an annual basis. And so you're constantly reinventing the wheel. And also what you do is you give over your identifiable information to these third parties, and they have all of the data, and then you're exposed to various risks. The banks that I know about, that I've been advising, they've even been looking at creating their own utility because they don't see KYC as being a form of competitive advantage. It's costing extraordinary amounts of money if you're a financial institution to impose and be compliant post-08.
So a common institution.
Yeah, but they can't agree with that. They can't even get to that. They've been as painful as KYC has been. They couldn't even agree to having a utility which could have made sense. I think where blockchain comes in is as follows: you go to bank number 1 and you go through your KYC process, and they do the traditional KYC. What happens then is bank number 1 puts an attestation on the blockchain saying we performed the following checks on this date, looking at the following documentation of this individual. When you go to bank number 2,
they just need to update it.
Sorry?
They just need to update it.
Well, all bank number 2 has got to do is verify a previously conducted KYC process, and they can get quite granular on that. They can see the underlying data. Interestingly, the individual retains their data. So when you give your passport or whatever your bank statement, you show a copy to bank number 1, but they don't keep it. So data remains on your device. So from a data storage perspective, that's helpful from cyber risk. Yeah. When you go to bank number 2, they approach bank number 1 says, okay, we'll sell you access to our KYC process, but it'll all be anonymized. What that does then is you've got a number of things happening. First of all, as an individual, it means that you go through the pain once, right? Secondly, bank number 1, who's gone through all of this utility of doing the KYC process, they have now got an ability to monetize that utility. So KYC and compliance, which is traditionally a cost function, becomes a revenue opportunity. Bank number 2, 3, 4, and 5.
For bank number 1.
Right, for bank number 1. Bank number 2, 3, 4, and 5, guess what? They don't mind paying bank number 1 because
they don't have to do it.
They don't have to do it. And so their costs of onboarding are going to fall by 90%. Yeah. Then when it comes to if you have an app, you have this, you have this particular app as an individual on your phone. Whenever you go to bank number 2, 3, 4, 5, it all just happens instantaneously.
Or anywhere.
Or anywhere.
You just got your KYC on your phone.
Right. And bank number 1, guess what? They're not only effectively making prices on KYC they've already done. They can also say, you know what? We'll do KYC on other customers. Yeah. So
they become the utility at the end of the day.
What you do is you make the digital identity a tradable asset, and that's what all of this is about.
So, all right, so we've got digital content, globally distributed, low cost. We've got digital identity being verified through the blockchain. And I know it's hard because it's like asking you to pick amongst your children. But of all your portfolio companies, you had to tell us about one that you thought was going to change the game in blockchain. Are your portfolio companies public? Who you have?
Can we talk about them? You're
No,
asking?
yeah, can you talk about them?
We can, yeah.
Okay, so give us your favorite portfolio company in the blockchain market or the blockchain space, or two.
Yeah, I love the analogy, like, oh, you can't pick your favorite child or things of that nature.
We won't tell them. We won't tell them.
Yeah, yeah. So there's, and maybe the delicacy is the company's still stealth, but there's been enough about the company. It's a San Jose-based California company. A bunch of folks that have come from Amazon, Facebook, Google.
Your
to-
friends.
Friends, yeah, exactly. Folks that we've worked with in the past, folks we feel very strongly about. So, obviously we've got the conviction, we invested in things of that nature. They've come together and said, okay, we've designed every cloud up until this point. If we could get together and uniquely stitch together a kind of Ocean's 11-esque type all-star team of the best guys in every critical discipline that enables a cloud infrastructure.
And we were to start over.
And we were to start anew.
Cloud
And-
2.0.
and, yeah, not try to kind of wedge something in or leverage pre-existing kind of infrastructures and architectures. How would you do it? Very well capitalized,
By you in part.
or in part, and then a very large strategic OEM that has a lot vested as well as some others. So the company called RStore, I don't know if I mentioned the name, but they've just done an amazing job of compiling a consortium of industry heavyweights who have a vested interest in a next generation cloud, many of which who are on the wrong side of the equation when Google's and Facebook's and Amazon extract the majority of the value from compute and information technology and are now enterprising the walled garden, which used to be enterprise information technology, used to be the places where only the EMCs and the IBMs and Cisco's would rule. Well, those aforementioned names effectively have virtually no economic participation in all the great profitability you see coming out of Amazon Web Services and things of that nature.
Other than selling the equipment underlying it.
They don't even get to sell equipment into those situations because the Googles and Amazons and Facebook are all doing their own. They've totally dismantled the whole supply chain and have basically ripped all the value out and are keeping it to themselves. So very, very shrewd. But we're seeing what we believe to be a bit of a blowback and an opportunity to design a deliberate cloud that's optimized for some of the aforementioned things that we talked about, like IoT and then the impediments to enterprise adoption. So these guys are attacking those core issues and saying, hey, we can outperform on capabilities and functionality, the things that enterprises are longing for, but like AWS cannot do because their cloud wasn't architected in the late 90s to do what the enterprise really needs. So they're an entity that I would say, as it pertains to applications and really novel and large-scale transformative applications of blockchain, I really think this RStore entity will be a darling. RStore, so just RSTOR.
So if you're keeping track, RCrypt, something in the digital identity space, and RStore. So Thomas, I'm going to give you my last question before we go to the audience. I'm going to give you an option of two questions. You can either tell us what you think the killer app in blockchain over the next year or two is, or you can tell us how S&P is deploying the blockchain to dramatically improve its business and the products it delivers to its customers. So either you can help your own company, or you can help someone else's company. You decide.
I have to think about it because I have to be on the disclosure, I guess. Well, let me answer the first question in a one sentence.
Okay, wow.
Okay,
Great.
and then I move to S&P Global just because I'm working for S&P Global. So I truly wish that the healthcare would move into the blockchain. Okay, and I think it's not
You
just
mean healthcare data?
the healthcare data and the services, because once you have the data, the services moving naturally into it, right? It's not just because we are so broken as a division of our lives. I mean, it's everything about the healthcare, but there's really a noble a cause, right? To help us ourselves and help basically reduce the cost and get this problem out of the way. I think that will be a very noble thing. I'm not sure if that will ever happen. Well, if that will happen in a short term, midterm, and a long term.
Why?
Well, if you look at what happens with Obamacare and what he tries to do, okay, and it took him basically 8 years, and then we unwind the majority of these things, okay. The healthcare is such a heavily regulated, okay, that moving the data into it and agreeing all these parties into this is such a complex workflow, okay, is almost impossible. I'm not saying it's impossible just because as complex financial workflows are moving into the blockchain, and I believe that the healthcare can do this the same thing. It's just that there's so much inefficiencies right now, and there is no leadership, okay, that will push that agenda.
So here, you heard it here first at the entrance to the law school, healthcare regulation, crushing the ability to do technology to improve healthcare.
And I tell you what, I mean, you know, just because of the prior panel, I truly believe that the blockchain has to be regulated one way or the other. In a healthcare, we cannot just regulate too much. We have to just relax this regulation a little bit and have that basically the fintech, not the fintech and that, but the health tech, I guess, right? The innovation just that kicks the tire. I mean, you know, there's so much room for the innovation and disrupt basically the bellwethers that we have today in the marketplace that, you know, there's so much opportunities.
30 seconds on S&P.
Well, an S&P, if I can say it, the data is the oil. The blockchain without the data is just the highways without the cars. Okay, nobody's going to move the cars on a highways without the oil. Okay, and so the data is the most important thing on the blockchain. Okay, all the decision makes, which is basically the smart contract applications, are based on the data. There's basically just a simple flow. It's the if that else, okay? But you have to have this construct. You have to compare one datum to the other datum. So putting the data into the blockchain is the most important, and that's what the S&P Global is playing the role in it as the trusted service, trusted party with the trusted data. We like to aid the financial workflows, financial basically systems, to trust the data and execute their smart contracts and streamline the financial operations.
All right.
May I make one very quick?
Yes, no, please, John, yes.
Data is the new oil, is a term you've already all heard. I think it's verified data is the new oil. So if you take the digital identity term that I used earlier, where I keep all of my financial information, but I've got bank number one that's verified it, even if somebody steals my passport and all of my information, if they don't have the verification by a registered third party that demonstrates that person who's now stolen my identity, if they don't have verification, then my personal information they've just stolen is not of use. That is, I think, a very, very powerful shift from a cybersecurity perspective.
Right.
It's not data, it's data plus verification.
Data plus verification. So, to the audience, we have about 15 minutes, so we'd love to take some questions. Stephen.
Hi, everyone. So I just watching your phone, which you shouldn't be doing this, but
I was checking the time.
yeah, no, but so Google just banned crypto ads, and the price is back 10% today. So do we care?
You're talking about cryptocurrency prices.
Cryptocurrencies
Bitcoin.
are banned from being advertised on Google
Yep.
as of like 11 o'clock today, and now the price is back 10%
Okay.
today. I guess Facebook did the same thing 3 months ago, and the price back 12%.
Okay.
Do we care? I guess I would ask the panel.
Do we care?
Do we care about the price
The fact that
correction?
Google well, the fact that Google's banned it and
I am not surprised about Google, near Amazon, Facebook, Microsoft. I mean, these are the people. I mean, these are the people that have the data. Okay, the most important thing in a making decision is the data, and they hoarding the data. So the blockchain, whether that's private blockchain or public blockchain, that's another means actually to distribute the data, to share the data. Okay, and that's basically just a business threat. That's a business disruption to their businesses.
So you're saying the reason Google is prohibiting ads for cryptocurrencies is because they are threatened. Their business model is threatened by the blockchain.
And I have to say that this is my personal opinion.
Of course,
It's not-
nobody's representing S&P Global or
No,
their
because we are regulated entities, so when we issue the opinion.
Well, I can go on further because I've actually gone on record and written research saying that's specifically what is happening. Sorry to cut you off, but basically, we live right now in a world where it's called Web 2.0. Web 1.0 was the original incarnation of the internet. Where we are right now is the second generation, which is social networks, user-generated content. The data is held in proprietary data stacks by Google, Apple, Amazon, Facebook, and others. So they've got all of our data. What's happening in the world of digital assets, crypto assets, is we're trying to create an entirely new middleware for the internet, which decentralizes the internet. And in essence, what that means is that you break the innovation capture cycle. What I mean by that is, if you look at the top 10 companies globally, they're worth about $5 trillion. Of those top 10, 7 of them are technology companies, and there's been an enormous asymmetry of valuation captured by those technology companies. Nothing wrong with that. The problem is...
Is that accurate, in the sense that, is that the right market outcome in your mind? Should they be in the top 10?
I don't know, if you're the best, capitalism means that's great. I think the issue is, in terms of what's happening is, when you've got the financial clout that they have, you've got the best and broadest development team, you've got AI, and you've got the broadest data sets, and you've got them held in proprietary data stacks. What that means is, if a new entrant comes in and competes and innovates, 2 things happen. Either they buy them, or they copy them, crush them, because they integrate it into their offering for free, which then further consolidates their ownership of the customer, which then means that they get more data held in their proprietary data stacks.
You're about to give us a but.
And, I was about to give you an and. And that then consolidates their position. So you have this innovation capture.
Right.
What's going to happen with Web 3.0?
Here's the but.
Tokenization means that we've got 2 things happening with Web 2.0. We've got this enormous control by large technology companies and the deficiencies of traditional business strategy. Now we've got tokenization, which means that if you are a new entrant, you have a piece of innovation, you can tokenize yourself. You create a token. I came back earlier on, I said it's about utility, financial incentives, network effects, and game theory. If you have an innovation which is genuinely got utility, you can tokenize that. Then you can create your own natural mini economy, be it users and producers, so individuals buying it for its utility, or producers who validate the network and the consensus. According to Metcalfe's law, the value escalates on the basis of, which correlates with the square of the number of users. And that then means that you are in a position to avoid data capture. As an individual, my data is not held in a data stack, it's mine. I will opt into it being used through a model where I earn reward for that. So it's a fundamental shift of business strategy.
Up into data use and so incentivize data sharing by consumers by essentially paying them for it.
Absolutely.
Own your own data.
It's also, I can tell you so you get innovation, you get enormous competition. So as a founder or of an employee of a new project which ICOs, you are incentivized to continually innovate your token so that you don't get overtaken by competition.
And you grow your network.
And you grow your network, but you will see, and we're already seeing it in the world of ICOs, the best practice of traditional venture capital and equity capital markets deals, which is that founders and employees are locked up until they generate valuation milestones. And so you get the best practice of traditional ECM and venture capital moving into the world of tokenization, which creates a business strategy which rewards innovation, and you get this extraordinary pace of innovation.
Pat or Ethan, any thoughts on this topic?
Go ahead. No, go ahead.
Yeah, I strongly believe that Google, Facebook, Amazon, Apple have profound control over what is going to happen with
Control you helped them get.
What's that?
Control you helped them get.
To read to Stephen's point about like why are they lashing out at cryptocurrency advertising and things of that nature, I don't think that these behaviors are a reflection of their concern about decentralization. No, I actually think it's their awareness that they need to be proactively regulating, because if they do not, somebody else will, and that's part of their.
It's sort of the Russia ads problem, right? We're going to do the crypto ads now, otherwise we're going to get it.
That's right. That's right. Yeah. So I strongly believe that's like priority number one in terms of their kind of outreach with.
They see the Elizabeth Warren tech lash coming.
Yeah. 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 And I would even contend that they have the ability. Let's take a step back, because I like this kind of commentary about how all the value has shifted into kind of the Googles and Amazons and the like. And so we talk about data is the oil of the modern economy. They get their oil for free, effectively. What I think happens over time is there becomes a shift where you who own the data contribute to the entities, at some point, you do get to capture value on that. And I don't know how that's going to play out. And at some point, what maybe happens at Google is they need to progressively start to.
They have to start paying you.
Monetize.
Yeah.
They have to let you on
Yeah,
it.
yeah, exactly.
Otherwise,
So-
you'll bolt.
Yeah, and so you see that, you know, on YouTube, and already some of that starts to play out a bit. But I would contend that we as individuals should be really, pushing for that and pressing for that, because I think it's only fair. So I only just share that because I think there's some different paths in which Google's and Facebook's, their business models may evolve, and they may be able to stem some of the, outside innovation value capture that we view as theoretically possible. I think there's going to be some interesting tension there.
One of the things, so in the core blockchain community, and I have some relationships that I'm speaking to just anecdotally, and when you think about Google and you think about Facebook, and I think it was in Germany and in Belgium where the Supreme Courts of both those countries ruled that the tracking that Facebook is doing of their users was ruled to be unlawful, and they have to stop doing it. In regards to the incumbents, the several large incumbent tech companies that seem to have all of our data and they provide all of our hardware, I would not be surprised, and I'm already seeing some technology that's going to be completely focused around providing hardware for the blockchain space. So you could actually, in theory, have in the future a SIM cardless cell phone that is not built by Samsung or Google, and it would be a blockchain distributed cellular network. You could have the same thing with computers. And there's this massive movement that I think a lot of the incumbents are very afraid of in regards to blockchains. It's not just about cryptocurrencies. It's about decentralizing all of our data and storing it decentralized. Taking it back. There's another project, and I've been following it pretty closely, the Pillar Wallet. Some of you may be familiar with it. It's being built in London. This is a wallet that allows you to store multiple cryptocurrencies, and you also can store your data on there, and you get to determine what data, if any, is sold and to whom and for how much. So that type of technology, I don't think any of the large incumbents are going to like, and that's very exciting. And I think those are going to be the next, Googles and Facebook. It's going to be decentralizing and taking back that data.
Other questions from the audience? Yes, sir, right back here.
If you look at any private blockchain, right, everybody runs a node, any company, most of the time a company is but in a public blockchain, although technically it's possible, balancing it is not yet. There's the amount of work required and the blockchain problem. So this public, but reality is still with some nodes, right? I mean, don't you think it's just shifting the power from say, not Google or Amazon, to certain number of non-blind people who are running it. I mean, if you look at
So-
it right now.
So to be clear, so the question is that you're simply shifting power. You're not really decentralizing. You're just shifting to a larger set of nodes, but not that many.
That's right.
What about that? I think this goes back to Thomas, to your question, to your point about public versus private, and
Right.
the idea that you only have a limited number of nodes in a private blockchain.
Right, but so let me just clarify something here, right? So in a public blockchain, okay, all transactions, regardless, are distributed to all computers that are connected to it
Simultaneously.
simultaneously. Yes, roughly. So even if you disconnect and you connect like a few days later, you're going to synchronize and get the delta of these transactions. In a private blockchain, okay, the transactions are distributed only, okay, to the nodes, okay, that participate in a smart contract transaction, okay, so not to all of those, okay. So that's just the one clarification I like to make, okay. So if you look at it from that perspective, then if all transactions are distributed and are indiscriminate, meaning that I can see your transaction, you can see my transaction, there's nothing to hide. There is no privacy, basically, in the data. In a private ones, there is a privacy. If I will transact with the 3 other banks, I don't want my wife to know about my other accounts they have, right? It's just these 3 banks, and plus, right, the FINRA, right, who is monitoring basically all the transactions, okay? So I just want to make sure that there's an understanding not the participation, but the visibility of the transaction level.
So like a VPN on one hand versus sort of broadcast message on TCP.
That is correct,
Yeah?
yes.
Okay. But what does that, tell us what that means for his concern that in this sort of, well, let me ask a slightly different question. Actually, let's go back to the audience. Let's not waste with another question for me. Other questions from the audience? Sir, right here.
So,
This will be our last question. We've got about 4 minutes.
oh, I'm so honored.
Congratulations.
That is a good question. As a company, you know, if we look internally, just how we're going to apply blockchain technology, are we too early to start looking at it to apply it to our own internal operations? And if we aren't, how do we do that? Are there developers out there? Are there strategists that come in and help you and say, here's your process, here's how you can take this component of your business and apply it to the blockchain
And make it more efficient.
and make it work within your organization today?
Great question.
Are we too early to start thinking about this?
Great. Ethan, let's just run down the road.
Sure. I mean, no, I don't think you're too early at all. I think obviously before anybody tries to say, hey, you should go hire these developers out of the Ukraine or these developers out of Sweden, they have to understand exactly how your business works and how, what are you using that blockchain for? Are you using it just for data capture? Are you using it for decentralized storage? For running better encrypted email, internal, for various internal types of encryption and data rendering, or other things? Are you going to plug in IoT? Are you going to start tracking shipments, say, in commodities, so you can get better insurance from, say, Chubb or Lloyd's of London? I've had those discussions with Lloyd's and Chubb about 1.5 years ago about just, hey, if we were to build an IoT solution for you, could we get better insurance because the likelihood of you having to pay out because we've got IoT and provenance built into this thing, would that be helpful? And they're like, yes, please show us something when you have it ready. So I don't think it's too early. I would also be, there are some consulting companies out there that can be helpful, but they're definitely going to have to get smart about your business and how to apply it, because whether you're going to do Ethereum, whether you're going to be doing a Bitcoin clone, or you're going to have a Bitcoin clone that also has a rootstock capability so you can build smart contracts on top of it, these are all things that really have to be well understood, and they're not going to be able to answer that for you until they understand exactly what you're trying to do.
Yeah, just very briefly, no, it's not too early. I do know that IBM were talking about how they save countless millions a year since 18 months ago by implementing an internal blockchain to manage their own procurement system. So I think now there are already various examples that consultants can talk you through of how to generate cost savings from private blockchains. Certainly, I think the key thing I would say for executive management is get educated on what is happening within the public blockchain space, because it's evolving very, very fast.
Yeah, similar feelings. I would consider it a board level checklist item. Like it needs to be.
Yes.
Yeah. There needs to be at least a preliminary assessment of it for both offensive and defensive purposes. Is it fundamentally have the potential to change my industry? And if so, can I get involved to shape it such that it benefits my business? Or can it fundamentally change my industry in a manner that could damage my business, marginalize me or things of that nature? Just make sure that, at least from my personal perspective, at least in broad strokes, you have an appreciation of how the landscape may evolve. And just interesting, I've set up countless meetings of folks. I think Doug Albrecht's still in the crowd, got fascinating background in education. He's talking about kind of the prospects of kind of education, blockchain, things of that nature. He should talk to a friend. You might, I think that stuff definitely should be happening. And interestingly, the same gentleman that I put him in touch with is a Bay Area guy now. He's in Chicago today talking to a friend who owns a freight company who's trying to understand, hey, what are the applications? And so, I just found that that's been pretty well received.
All right, Tom, for 1 minute over, so last chance to you.
I'm honored as well. So it's not too early, that's for sure. But as everybody else said, you need to do the SWOT analysis, okay? And you have to involve basically each owner of the business line and the technology. And perhaps that will be just the one opportunity to sit down together with the business, technology with the business, and having the understanding what the technology is about and how is that going to disrupt your own business, and how you actually could disrupt the other business to take an advantage of it.
Awesome. Thank you all.
Thank you.